Now, Carl, I will start with you on the stock of the day. Kashi's had a bit of a big cap theme going this week, so who am I to change it up on a Friday? I thought we'd look at Wesfarmers off the back of the result that you did reference there. So a 16%
Sure.
spike in annual profit to $2.4 billion, revenue surging. On the lockdown, though, impacting group sales, and they're already seeing that in the first little bit of FY22. And last I checked, so this is at just past the noon hour here in Sydney, Wesfarmers down by 3%. So Carl, you're a Perth boy. Why I'm starting with you. The market is choosing, at least right now, to focus on what's to come, not what's past, correct? What did you make of the result and where to from here for Wesfarmers?
Yeah, definitely. So, look, a great result, a solid result, and the sort of result we've come to expect from Wesfarmers with this sort of conglomerate model where they've got all these different pieces of the puzzle all working together to deliver them, great numbers, and that is obviously a reflection on management's ability to pull that off, and that's very impressive. So, you're definitely paying for quality here and sort of sleep at night factor, but unfortunately, having put all of those wonderful things on the board, we then have to look forward, and half of their stores are closed. Basically, if you're looking at Kmart, Officeworks, Bunnings, I guess Bunnings is still open, of course, isn't it? Essential services, but that's going to take a chunk out. And when we first came into these lockdowns, there was great hope that it would be a few weeks or a week. Maybe some optimists were thinking. Now we're a few months. We're going to knock out the first quarter for the most part, certainly in New South Wales. So it's going to have an impact on the bottom line. They're not making it up. We're not seeing that huge surge in home renovations that we saw at the start of the pandemic back in 2020 from Bunnings. We're not seeing this huge switch to work from home that's helping Officeworks and Kmart to some extent, because we've done all of those things already. We're not seeing this big switch to online sales that's helping catch. So yes, unfortunately, markets look forward for Wesfarmers, and that's why the share price is pulling back. It's pulling back from a point where the shares weren't exactly cheap anyway. Mm-hmm. But look, having said that, I think if you've got it, I think you should hold it. The chart looks really, really, really strong. There's always ebbs and flows in any trend. It's a wonderful long-term uptrend. It's pulling back, sure, but don't panic. I think there's going to be lots of support around that sort of 59 to 60 level. And by my valuation here, we've got a sort of a fair value target around that $63 mark. So I think you're starting to get some value back in it there, and it would be a buy in that zone for a longer term portfolio holder.
Well, Jun Bei, that's what I was going to ask you, because most talk to the quality aspect of Wesfarmers, the diversification. I mean, it's primarily Bunnings and the retail arm, but there is some diversification in there. So on a pullback such as we're seeing today, could it be a buy?
Look, there's no denial that Wesfarmers has the best retailer. Bunnings is probably one of the best retailer around the world. It's done incredibly well, but don't forget, it is mature. So, today the pullback we're seeing in Wesfarmers, if you look at over the 12-month or 18-month when we had the whole COVID disruption, it's not much of a pullback at all. In today's market, the people are paying a lot for so-called quality companies, and but at what price? Wesfarmers at this point is trading on the forward earning of close to 35 times. Now, traditionally it trades about 20 and at a premium to the market, now to 30, close to 35 times. And its earning in the next couple of years are going to fall, simply because they were the big beneficiary of the government stimulus towards consumer, towards the home builders. So there was a lot of home construction activity that boosted the Bunnings earnings. Now, so these earnings are going to fall, and you're paying a big multiple on what is a peak earnings. So, so to me, I think in the next 12 months, the capital is better allocated elsewhere. There's a lot of blue chip quality business that earning has been impacted by COVID, such as Ramsay, and then it's on 24 times when all the other healthcare businesses trading on 40. So so I think this is a market that you see a lot of quality business. You do need to take a longer term view, and then work out what is the right value for this business. So for Wesfarmers, my view is that it's probably not going to do all that much in terms of share price, and your capital is better allocated elsewhere.
So that's a sell then, Jun Bei. Best is...
I will put that's a sell for me and put into the company like Ramsay.
Okay, that's a bonus buy, people. I will tell you that Ramsay Healthcare, in the wake of its results this week, Jun Bei, no doubt has just run the numbers, so there you go.